If you want to invest in the very best dividend stocks in the world, then you wouldn't go far wrong by investing in stocks on the S&P Global Dividend Aristocrats Quality Income Index. This is an index that brutally screens for stocks with incredible records as dividend payers. In fact, of the tens of thousands of stocks in the world, only around 100 make the cut.
But as stock pickers, can we do even better? Who wants to invest in 100 dividend stocks when you could invest in the best 20 on a commission-free trading app? We think investing in the top 20 dividend stocks in the world will still give you sufficient diversification while also giving you a better income than spreading your money more thinly over 100 stocks.
I'm going to put this theory to the test by adding to my portfolio the best 20 dividend stocks from the UK, US and Europe. Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. What dividend investors need? You need a high yield, right? Well, yes and no. While of course we do want as high a yield as possible on our dividend stocks, we don't necessarily go looking for super high yields when we invest.
It's great if a high quality passive income stock that you hold matures into paying out a higher yield over time, but investing off the bat in a very high yield stock is normally an error. A high yield can be indicative of underlying problems. A high yield suggests that investors are worried about the company, which has made the share price go down, driving the yield up.
Yield is simply a formula driven for the most part by the share price. If a stock pays £5 dividends and the share price is £100, you have a 5% yield. But if the share price falls to £50, now you have a 10% yield. Yields of this size are not sustainable. For the share price to crumble, the company's cash flow is probably in trouble, and they will be cutting their dividend at the earliest opportunity.
What we want is a good but not over the top yield, something like 4 to 5%. More than this, we want our income to be stable and reliable, for dividends to grow over the years, and for our income to be from quality companies that can weather a storm such as a bad recession.
Dividend Aristocrats. Stocks like this are found in the Dividend Aristocrats funds. The Dividend Aristocrats funds track a series of indexes designed to measure the performance of high dividend yielding companies.
Arguably, the main fund is the SPDR S&P Global Dividend Aristocrats ETF, which considers all stocks from both the developed and emerging markets. The UK gets a far stronger showing than most global funds at nearly 9%, because the UK is home to some wicked dividend stocks.
To qualify, stocks must have followed a managed dividends policy of maintaining or increasing dividends, and they must have an unbroken track record of doing this for at least the last 10 consecutive years. They also must have a positive return on equity and a positive cash flow from operations. The number of global stocks which pass this entry criteria are vanishingly small, only 100 companies in the whole world.
Here's a listing of the top holdings in the fund, and you'll probably recognise some of the classic dividend payers. ExxonMobil are there, as are AT&T, GlaxoSmithKline, Tate & Lyle, IBM and BAE Systems. These 6 are all dividend stocks that will appear in most income investors' portfolios. It might surprise you that only 3 of them are good enough to make it into our final cut.
The entry criteria of this Dividend Aristocrats fund has already done the bulk of the heavy lifting for us when it comes to our fundamental analysis of which dividend stocks to invest in. For this test, all that's left to do from here is to narrow this pool of the elites down further, with final tweaks from Stockopedia to leave us with just the dividend megastars.
Our method. Starting with the listing of the stock holdings in the Global Dividend Aristocrats ETF, we cross-reference these with data from Stockopedia, our favourite stock analytics site, to get the stock rank for each, as well as individual yields and other fundamentals.
To get adequate diversification, we added a rule that there could be no more than 3 stocks from the same industry in the portfolio, and no more than 5 from the same sector. An example is no more than 5 financials, which is a sector, and no more than 3 insurance companies, which is an industry within the financial sector.
We kept this rule fairly loose, accepting that this would probably mean 5 financial stocks in the portfolio, as certain key sectors, such as financials, are historically epic dividend payers, and we didn't want to tie our hands too much from getting the best dividend stocks.
The portfolio did indeed end up with 5 financials, 3 banks, 1 insurance company and 1 capital markets company. 3 quite different industries. Finally, to make this portfolio open to everyone, we've built it in Trading 212, using their pies feature, which meant our stocks had to come from the UK, US or Europe and be available on the app.
The portfolio. Here's the portfolio, the top 20 dividend stocks according to the Dividend Aristocrats Index, Stockopedia stock rank scores, and our handful of fixed rules. The average dividend yield on this portfolio is 4.6%, which is very good, especially considering that many of these stocks are from the United States, where the dividends are traditionally far lower.
There are some big names in here, with the smallest company having a market cap of £0.9 billion, and massive beasts like Pfizer, AT&T and Verizon all worth over £100 billion. Every one of these stocks has a 10-year plus consecutive record of maintaining or increasing dividends, has solid returns and cash flows, and rates highly in Stockopedia on quality, momentum and value metrics.
The stock rank. Stockopedia is our tool for analysing stocks, and loads of our regular viewers have been signing up to and finding out for themselves why it's so useful. The stock rank in Stockopedia is a summary of all of a stock's fundamentals, summarised in a single number.
For the purposes of this portfolio, the Dividend Aristocrats Index had already done most of the work in fundamental analysis, so we felt we could justify looking no further than the stock rank for this experiment. But if you wanted to dig further into any of these stocks for yourself and see the detail, you can start a 14-day free trial on Stockopedia by using the link on the Money Unshackled offers page, linked to in the description below.
Those who choose to stick around for longer than the free trial will also get a 25% discount off your entire first year's subscription by using the link. It's a big saving not to be ignored. Our filtering has meant our portfolio has an average stock rank of 86, with the top 12 being ranked at least 90 out of 100.
These are superstar dividend stocks, which make up 25.2% of the market cap value of the original Dividend Aristocrats fund. We've effectively carved out the top quarter of the fund, leaving this portfolio all killer and no filler.
Trading 212 Pi. Those of you using commission-free trading app Trading 212 can follow and even copy this portfolio by finding the Pi we've made on the app. You'll find the link to this in the description below this video.
For our test, I dropped £1,000 into this Pi, but as you can see, some loose change didn't get invested by the app for whatever reason, probably due to prices moving in real time while the app was buying the stocks. Rather than weight by market cap, we treated all these stocks equally and given them a 5% allocation each in the portfolio. All these stocks had to pass through a trial by fire to get into this Pi, so equal respect to all of them. We'll be updating the Pi every 2 to 3 months to keep it fresh as stocks fall in and out of favour.
Any dividends the portfolio makes will be tracked in this screen. What we ultimately want to do is compare the dividends received into this Pi against those paid out by the original ETF that it's based on. We'll also want to look at total returns. We'll come back to this in a few months and share with you how it went.
Advantages of this portfolio. This refined 20 stock dividend portfolio has several advantages over using an ETF, but is only really worth doing if you're using a commission-free trading app. Buying 20 separate stocks on a traditional investing platform, which charges trading fees, is probably going to land you with a high fees bill to pay.
But assuming you're using an app like Freetrade or Trading 212, here's why the portfolio rocks. Number 1, fees are lower. The Global Dividend Aristocrats ETF that we've built from has a reasonably high ongoing charges figure of 0.45% annually. That's nearly 0.5% wiped off your return. Buying a selection of the best stocks in a Pi avoids these fund fees.
Number 2, regular income. In the ETF, dividends are distributed quarterly, but your income will be paid much more frequently than this in your Pi. For instance, Omnicom pay dividends quarterly in January, April, July and October. AT&T and Verizon pay out in February, May, August and November. Pfizer and IBM pay their dividends in March, June, September and December. Between the stocks in your portfolio, you're getting paid something every month. You wouldn't be happy if your employment income was paid quarterly, so why should you settle for anything less than monthly from your stocks?
Number 3, higher returns, in theory. This is yet to be seen, and we'll come back to this in a future video. But in theory, we've picked the companies with the best payment records and the strongest fundamentals, so we're certainly hoping so.
So who didn't make the cut? We mentioned earlier that 3 of the big classic dividend payers present in the Dividend Aristocrats ETF didn't make the cut into our Pi. These stocks are ExxonMobil, GlaxoSmithKline and BAE Systems. What was wrong with them? Of course, Stockopedia has the answers.
ExxonMobil's quality score has tanked recently, with negative return on equity and negative operating margin. Basically, it's been making huge losses throughout the pandemic, being an oil company. Could this lead to dividend cuts? Maybe. We think it's a decent idea to invest in oil right now, but for the short-term growth potential rather than the dividends.
GlaxoSmithKline's share price is on a downward spiral. Also, its momentum score of 2 out of 100 screams at us that this is a stock worth avoiding right now, as do the red flags that say it qualifies for 2 short screens, basically lists of bad stocks. And its future dividends are forecasted to be cut, probably for the best that this stock is sidestepped by using our pie rather than the ETF.
Finally, BAE Systems is just a bit dull, with none of the scores making it stand out as a stock. It's on one of the short screens, but its returns look okay. There's probably not that much wrong with this average stock, but we don't want average in our dividend pie, we want the best of the best, and BAE ain't one of them.
Question of the day: will you be investing in the MU Dividend Aristocrats pie? What do you think of it? Join the conversation in the comments below, and don't forget to give Stockopedia a free try.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.